as you said, so the focus is going to be on the cost of credit, cost of risk. And I mean, we've seen over the last few years that the net charge-off, so essentially the loss rate for the banks, has been hovering around a little less than 0.08%. But of course, so all the banks already come forward and say that this year, and also it's quite natural since so the economy is already under recession, and we do expect an increase in the cost of credit. To be fair, I mean, if you look back at history, the peak in charge for American banks was around 3% during the global financial crisis, 2009, and I think it would, of course, also will depend how long the lockdown will continue, but I think it's fair to say that at least 1.5, 1.6% for this year. So actually very high level of cost of credit.
When it comes to outlook, the bank's now dealing with ZIRP, effectively zero interest rate policy, but there's been much debate about how much further monetary policy could go, whether the Fed ultimately is forced into negative territory on rates like we've seen in Europe. What do you make of that impact currently where the banks stand, and what could be down the track for them on monetary policy?
Yeah, that's a very good point, because unlike, for example, the European or Japanese banks, of course, also the American banks have gained an healthy net interest income over the last at least 3 years, because of course, also the Fed up until 2018 has been on a hiking path, and therefore, I mean, the banks also were able to actually earn positive money on the holdings of Treasury, which, unlike, for example, French banks or German banks, of course, now also the rates went to zero, and therefore this is going to be a very significant headwind for the net interest income and the P&L of the U.S. banks. Whether the Fed also will go below 0%, I don't know, because I mean we don't really have any historical precedent. It's to some extent also the U.S. financial market doesn't really work with negative rates, unlike some geography in Europe. So it really remains to be seen. I think also what the Fed announced last week on terms of corporate bond buying, that could be helpful to the banks, because as you know, all those corporates have been drawing on the credit facility provided by the banks, and of course that's been as an effect, because the balance sheet of the banks has ballooned quite significantly over March. I think we're talking $350 billion, which is double the annualized rate on loan growth. So I think also if there is someone else, investors and the Fed, buying back corporate bonds, then also it could alleviate a little bit of the pain on the balance sheet side for the banks.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.